welcome to our very first video blog. My name is Michelle Kessel-Harbart, and I'm here with Ken Brown.
Hi.
And we are a wealth management team at Avisen Securities. First off, we would like to say that we hope everybody watching today is safe and healthy. We know this is a very challenging time as we all deal with the coronavirus pandemic. But the reason why we're here is, let's talk about the market. After all, it's on everyone's mind, and we're right in the thick of it.
Boy, are we. Yeah, I thought maybe we could discuss the macro picture a little bit and kind of give you our view on the economy and perhaps where this is going. First of all, we don't take this lightly. This has been a very dramatic both decline in the markets and a very, very abrupt drop off in the economy. This just is really a classic black swan event. It's one that would be very difficult to predict in advance, very difficult to see coming down the road. So we do not, and I don't think the markets do yet, have their arms around either the magnitude or the duration of this correction. Yesterday, the day before, the market hit a low point of, I think the S&P was down a bit over 30% through this decline. We're not at all sure that represents an absolute bottom. What we've seen subsequent to that is we've seen sort of a relief rally where the federal government has stepped in. The Fed on Monday with heavy buying programs extending into corporate bonds and other commercial paper. And just yesterday and today, it looks like the finishing touches are being put on a fiscal relief package in the Senate in the neighborhood of $2 billion. It'll be interesting to see how that's allocated. In essence, who gets what, and we'll know more, of course, over the next week or so as that rolls out. But at any rate, the economic numbers that we're looking at are really all over the board. Goldman Sachs, for example, has the economy declining at around 14% as represented by GDP. That may be, it seems perhaps a tad conservative given the nature of this, the fact that entire segments of the economy are being shut down, entire states are being shut down, and again, it's open-ended as to how long that lasts. The worst prognosis I've seen was from Morgan Stanley, which looked for GDP growth to decline through the second and third quarter at roughly 30% year over year. And also for corporate revenues to decline at around that same level, at around 30%. That is not priced in to the market. Those kinds of numbers are simply not there. There is going to be a ratcheting down of analyst estimates going forward. So this is not a period where we can go into the end of the quarter and we can look at these numbers that are coming out now from companies, or that will be coming out shortly, which are always backward looking. This is not a time to look backwards. This is a time to try to get our arms around, again, the depth and the duration of this thing. I think it's highly improbable that we're going to see what they call a V-shaped recovery, where we get this very steep decline, and then this right away, this recovery, where it comes right back. I understand, again, the near-term aspects of oversold rallies and so forth. Typically, what needs to happen before we get a all-clear signal would be something like 1, 2, or 3 tests of a low. And so we perhaps have some time in front of us before we're going to, absolutely establish, what will amount to a low. So that's, I think, more the big picture. So, Michelle?
So what are you looking at down the road as far as sectors and such as we get through some of this?
Well, again, assuming that the horse is 2/3 to 3/4 the way out of the barn, and we're beginning to again gain clarity feel as though we have, some insights into recovery. We're going to be looking for things like, again, jobs returning. We're going to be looking for things like, for example, from China, that that supply chains are back up and running. That we're seeing container shipments, train loads, and we're seeing cargo ships and so forth with sort of reestablished at previous rates. And again, we'll be looking for jobs to return. It's very difficult for the economy to recover without the consumer recovering. It's a consumer-driven economy. Trust me when I say that we're not going to see capital expenditure on the part of business pick up anytime soon. Business will be extremely reluctant to spend money coming out of this. And of course, we do have the government, leg on the stool, which is very pronounced right now with this fiscal stimulus plan at $2 trillion plus. But so in terms of sectors, to answer Michelle's question in a roundabout way, I think that the sectors likely to outperform going forward will be, in one sense, sort of defensive, and that could be areas like healthcare, for example, could be one that can remain relatively stable through this and then come out of it fairly strong. I don't think that the political situation, the elections and so forth, are going to threaten the healthcare industry as was felt at one time. So I don't believe that's a factor. Areas in healthcare that we like, might be, for example, some of the more cutting-edge biotech, and a way of playing that might be an ETF, an exchange-traded fund, for example, XBI. XBI invests in small, mid-cap, and large-cap names, and that's a way of sort of diversifying your risks so that you're not necessarily dependent on FDA approval anytime soon for one individual product. Some of these new technologies in gene editing and CRISPR technologies are really fascinating, as it sort of pinpoints therapies for individuals, and this is all coming online now as we speak. So I think that's an area that could outperform, and clearly an area that we can't overlook, and the market's certainly not, because as evidenced by the money flows going into the market now, we're seeing a lot of money pouring into technology names, specifically names that are going to be beneficiaries of a outsourced world. That means that people are gaining this experience of working from home offices, lack of commute, being able to basically get high levels of production done without having to leave their home offices. So what does that require? Well, it requires, of course, technology. It requires connectivity, for one. And so areas like cloud computing and data centers and 5G technology for wireless in the home, we think could explode to the upside. Demand could be quite a bit larger. Clouds to the edge of the networks as opposed to the large public clouds, or in combination with the large public clouds. So, an area, a company that's done, just to pick on one, I suppose, that's done very well through this in terms of traffic is Facebook. What do people do when they stay home? Well, they look at Facebook and they communicate with their friends. And Michelle, in fact, had a virtual cocktail party at home last night, and
Sure
a good excuse to drink, right?
Exactly. Exactly.
So I think there are going to be areas, and we can see it now in these little spikes. There are going to be areas where the money is going to flow, and think in your minds about it being sort of a 21st century economy move, as opposed to necessarily supporting things like oil and air, or energy, which is likely to stay under pressure for a good long time.
What about other dislocations outside of equities? What are you looking at?
Well, it's interesting. Like 2008 and 2009, we have seen the bond market, sort of discombobulate. We've seen spreads widen between quality municipal bonds and quality corporate bonds and treasuries. So treasuries, of course, are the safe haven, if you will. But again, quality names in municipals, AA, AAA rated, names that have performed for years, are now trading at 200 to 300 basis point spreads over and above their treasury counterparts. And that could actually widen a bit more. And the reason is because holders of municipal bonds, in some cases insurance companies and banks and whatnot, in some cases need to sell quality assets in order to support other areas of their portfolios. So if the market continues to weaken, other areas of credit weaken, again, you could see a large influx of offerings coming into the municipal bond market. It's not an efficient market, which means might be time to shop.
And what about cash? What kind of a role does that play?
Cash acts as a defensive, holding tank, if you will. Again, the Fed has stepped in and aggressively supported liquidity and money market funds, so we're not that concerned as we saw in 2008 and 9, where we had some real lockups in money market funds. That's not a concern of ours right now, and we'll keep an eye on that, but the Fed's aggressively on that. Basically what the Fed's been able to do is take the playbook from 2008 and 2009 and apply it to some of the cases that we're seeing now, mm-hmm. especially in the credit markets. Mm-hmm. So cash plays a defensive role, but I also think of it as the dry powder that'll go to work once we get more of our arms around the duration of this, and again, the depth of this. And we still think we're kind of in the early innings, and again, the street is all over the board.
Mm-hmm. One of the other things I wanted to touch on was the importance of having a financial plan. So successfully navigating through all this really is about preparation in advance, right?
Oh, absolutely.
So we work with our clients as far as having that financial plan in place where we can anticipate these types of market declines and see what that does to their plan so that they can be successful and their probability of success can be successful down the road.
Right.
And taking into consideration their asset allocation, their risk tolerance, risk capacity. So I encourage any of our clients that we haven't worked with on a financial plan or a retirement income plan to reach out to us and let's put one together. Now's better time as any.
Yep.
And also we'd like to reach out to your friends and family, and if you have anybody that you know of that's just incredibly worried during this time and doesn't think they are in a place they should be, we want to offer complimentary consultations to meet with them and give them second opinions or whatever kind of advice they need on their portfolio, their 401k accounts, and offer our services for financial planning, just so that when we come out on the other side of this, everybody's in a better place.
I guess putting it another way is it's not a real good time for people to be attempting to walk alone down this path. It's pretty dark and pretty scary. So to the extent that we can offer our assistance, we've been through this before, happy to do so.
Right. So we want to thank everybody for watching. Again, this was our very first vlog.
Yeah.
We're going to be providing more of these types of videos for everybody on different types of educational topics. We hope you enjoy them. We will hope you subscribe and give us a thumbs up and provide us with your feedback. So again, thank you for watching.
Thank you.
Please be safe and
by all means.
Yes, take care. Bye.